Hello and welcome to the Tax Roundup for June. This month we take you through the key budget announcements and how close or otherwise those announcements are to becoming reality. You can follow us on Twitter and we'll also keep you up to date. And members, there's a budget update page where we keep track of all the announcements and the status of them. We also take a look at the ATO's attack on shared economy services like Airbnb and Uber and some of the outcomes for taxpayers. And finally, we take a look at two really important CGT cases. These cases have the potential to change the ATO's long-held position on accessing the CGT concessions. But first up, across to Ray to look at the reduction in the company tax rate.
On budget night, the Treasurer announced that the company tax rate for small business entities, so that's companies where the aggregate turnover is less than 2 million, that company tax rate will drop from 30% to 28.5% from the 1st of July 2015. We now have the legislation before the House of Reps, and hopefully that will get through in time so that it will take effect on the 1st of July 2015. Now, interestingly, even though the company income tax rate is going to be dropped, franking credits still stay at 30%. So for those small business entity companies where they have the franking credit balance, they can still use that going forward. However, we haven't seen for other entities, for example, if the business is run through a trust, what's going to happen with them. Legislation for those are still to come through.
Now, following hot on the heels of the budget mid-month, we've finally seen some legislation come through Parliament for the immediate deduction threshold for small business entities. Now, that bill also contains the brought forward measures for primary producers, which was a nice surprise towards the end of the month as well. So the $20,000 immediate deduction threshold for small business entities, the bill and the EM confirm that in order to qualify for that, the asset needs to have been not only first used or installed ready for use from budget night onwards, it also needs to have been acquired after that date too. So what will no doubt happen is we'll end up with some question marks over exactly when was that asset acquired. Was it when the contract was entered into? Was it when the purchase was entered into? We'll probably just have to work through those details as we come to them. One of the other things that the bill confirmed, which was a little bit uncertain on budget night itself, was the deduction that you can claim for low pool balances. So at the moment, that threshold is $1,000. So if the balance of the pool at the end of the year is under $1,000, you get to just write off the rest of the pool value. That threshold is being increased to $20,000 as well, and the bill and the EM have confirmed that that will apply to the current year, the 2015 year as well. So even though most of the year is done, if the balance of the pool is under $20,000 at 30 June 15, then you can claim an immediate deduction for what's left in the pool. So the 2015, 2016 and 2017 years will qualify for that low pool value deduction as well. The other thing that this bill contains, as I mentioned, is the new rules for primary producers. If you have primary producer clients who are buying assets, they may actually have a situation where they qualify under either the small business entity rules, if assets were bought for less than $20,000 and they are an SBE. Alternatively, they could qualify for the new primary producer rule. So 3-year write-off rule for fodder assets or immediate deduction for water facilities or fencing assets. Basically, for those clients, it's up to you. You can choose which one gives you the best result. For clients that are not SBEs and carrying on a primary production business, then those rules will start as stated by the Treasurer during the month, a little bit earlier than what was announced in the budget. The start date was originally going to be 1 July 16. That has been brought forward to budget night. So from budget night onwards, assets that have been acquired, expenditure that's been incurred on those fodder assets, those water facilities and those fencing assets, in theory should qualify for those faster deduction rates, either immediate deduction or a 3-year write-off rate for fodder storage assets. So some good news, good to see the rules actually coming out now. It gives us a little bit more certainty. Hopefully things will pass through Parliament before the end of the financial year, and it will then be up to us to let clients know exactly what they might qualify for.
From the ATO this month, some of the tax outcomes for sharing arrangements like Airbnb and Uber will come as a surprise to many taxpayers. Ray explains.
Let's talk about sharing, because the tax office are. They've just recently issued guidelines in relation to the sharing economy. So they're thinking about small things that perhaps people thought wasn't really an issue. but it is, and they need to pay attention. The things the tax office are looking at are like sharing, doing small odd jobs, perhaps renting out a spare room, car spot, possibly giving people lifts in cars, anything that might be generating accessible income. Now, in the past, a lot of people have thought, oh, it's a small thing, I only do it from time to time. It's really not income, is it? But it is, and the tax office are very firm on that. So they have issued guidelines in relation to what is the sharing economy, giving specific examples and indicating how the taxpayers should be reporting this accessible income and deductions they may be eligible to claim. But it is important to remember it's not just the current income tax reporting obligations that these taxpayers need to think about. What about the interaction with other parts of the legislation? Now, the classic example would be the main residence exemption. If somebody is renting out their home and they vacated it, they can make an election later and still have their full main residence exemption when they sell that property. However, if they're still living in the property and they're only renting out the spare room, like an Airbnb arrangement, then they cannot make that election. Therefore, when they sell that property down the track, they need to remember there will be a CGT implication because they will only get a partial main residence exemption, not a full one. Something perhaps they hadn't thought about. Ride sourcing, more commonly known as an Uber arrangement. This is an arrangement whereby a driver will have a car that they're willing to give a passenger a lift in, and there is a third-party facilitator that provides some sort of technology or app that allows them to connect with each other, and therefore the service is provided. Now, a lot of people have used this in the view as something simple to do part-time, but they might not be thinking there are income tax issues, there's also an awful lot of GST issues to be dealt with as well. That is an enterprise, and unlike most types of enterprises, the threshold amount is zero. When a taxi travel is provided, and Uber is regarded as taxi travel by the tax office, then there is no threshold. From the very first dollar, GST must be charged. Now, the tax office does recognise with the increase of Uber type facilities, people might not be aware of what their obligations are. So they're giving people until the 1st of August 2015 to become compliant. Now that time is going to march on very quickly. So for any clients that might be providing these type of arrangements, it's very important that they understand they need to be registered for GST and they need to do it very quickly. As we know, ignorance of the law is absolutely no excuse. Therefore, for anybody who's been provided the Uber services, they need to be aware that they were required to be registered for GST when they started to provide the services. If they have not taken care of that, they need to do so now and put the correct effective date on their application. Now, regardless of whether they actually charged GST to their passengers, they provided a taxable supply, they were required to charge GST, so 1/11 of whatever they did actually charge is now the GST component to be remitted to the tax office.
In cases this month, if some of your clients missed out on accessing the small business CGT concessions because of the maximum net asset value test, then these two latest cases may change their position. Michael Carruthers explains.
Now, we've also seen over the last month or so some interesting AAT decisions around the small business CGT concessions, and this seems to be a theme that we pick up pretty regularly, and it is of interest to a lot of small businesses when selling assets or selling their business. The first case is the Davuba decision, and basically that case looked at a situation where you had dividend access shares. Now, for those of you who've had to confront this issue in the past, when you've got a company which has different classes of shares, those different share classes can cause some significant problems in terms of accessing the concessions. And the reason for that is it can play havoc with the significant individual and the CGT concession stakeholder concepts. For years, the ATO's position has always been that if you have different classes of shares, you as a shareholder may struggle to access concessions unless you hold all of the classes of shares. Because what you need is to demonstrate that you have a fixed entitlement to 20% of dividends, 20% of capital distributions, and 20% of voting power. So if you've got different classes of shares on issue, some that have just dividend rights, some that just have voting rights, it can get a little bit mixed up and you can actually potentially miss out on the concessions. Also, the ATO has told us for a number of years. This AAT decision actually is an interesting development and goes the other way. The AAT basically just looked at the rights that are attached to the ordinary shares and said, as long as those ordinary shares had 20% of dividends, capital and voting power, then the relevant tests could actually be passed. So quite a departure from what the ATO's position has been for quite a while now. Now, in terms of what you do with that information right now, I'd probably just wait and see a little bit. Let's wait and see what the ATO does, whether the ATO appeals the decision, whether it goes any further. If not, well, then it probably opens up the concessions to some people who we thought may not have qualified. So pretty good news. But before you kind of rush in and rely on that decision, let's just wait and see what happens. The other decision that's interesting is the Accela case. It deals with quite a different area of the small business concessions, and it's around the maximum net asset value test. Now, this is a case that's kind of looking backwards when the test was a $5 million test rather than a $6 million test. And without going through all the details and all the issues, some interesting things just to note. One of which was when you're looking at the maximum net asset value test, when you've got cash sitting in a bank account, that bank account, those rights you have against the bank, that is a CGT asset, and that is an asset that would need to be included in the $6 million test or the $5 million test for prior years. One of the other areas that was quite interesting was around partnerships. When you're looking at the $6 million test, you need to include the net value of your assets plus the net value of assets of connected entities, so entities that you control. Now, when it comes to the connected entity rules for partnerships, the rule suggests that if you've got an interest of at least 40% in that partnership, then you are connected with that partnership, you control the partnership. By extension, one way of reading it is that if you control the partnership, you would need to bring in 100% of the net value of that partnership's assets when you're testing your position. Now, in this case, the starting point seemed to be that even though the taxpayer had a 50% interest in the partnership, they only had to bring in 50% of the partnership assets. That then led the AAT to conclude that the partner was only able to deduct 50% of the partnership liabilities, even though they were jointly and severally liable for all partnership debts. But the interesting point there was the acceptance that only 50% of the partnership assets need to be taken into account. Again, we probably just need to wait and see exactly where that goes, whether there's appeals against that decision by either the taxpayer or the ATO, and whether the ATO releases any sort of decision impact statement, setting out in a bit more detail their views of that decision. But all in all, some really interesting developments, potentially opening up the concessions to people who might otherwise thought they had failed. And it might be worth, in some cases, actually starting to think through any client scenarios where you've thought that they might have failed the concessions and you haven't applied the concessions because of some of those factors. So now's the time to start identifying who those clients might be and keeping an eye out on where these cases actually go to. So interesting times at the moment in terms of small business CGT concessions, and we'll just see how those things play out.
And that's the tax roundup for this month. Don't forget, as we head towards a new financial year, if you want to be absolutely up to date and ready for the new financial year, then take a look at what the Knowledge Shop membership offers. We've got updated work papers, standards and precedents, and not only that, we'll keep you absolutely up to date with what's going on. Give Julie a call on 1800 800 232 to see what's on offer. See you next month.